The Federal Reserve continues to learn that overcoming the momentum of a strong employment is continually difficult. They're going to have to manage the interest rate increases very closely. We're going to talk about what it is that's going on and how it needs to be overcome and how that is impacting the markets.
Welcome to the Trending Report, brought to you by USA Financial. The Trending Report is a bi-weekly show that aims to focus on the trend lines rather than the headlines. Each episode features commentary around the state of the market, as well as other factors that may impact your personal finances. The host of the Trending Report is an investment advisor representative of and securities are offered through USA Financial Securities, member FINRA SIPC, a registered investment advisor. The Trending Report is educational and not intended as personal financial advice.
Welcome, as always, back to the Trending Report. Today, we're going to be discussing data relating to the end of last week, which was Friday, August 11th. And today, we're going to put a special emphasis on discussing the fact that momentum is hard to break. Momentum is hard to overcome. Momentum is hard to challenge. And that especially is something that the Federal Reserve is having to deal with as they're continuing to try to get their arms around inflation and how that's affecting volatility in the stock market. As always, we're going to look at the market from various different categories or positions, I should say. So a viewpoint one being capitalization, large cap to small cap. View two being from a sector standpoint, the 11 sectors that make up the S&P 500. View three is going to be the international equity markets. And then finally, we'll wrap things up taking a look at the U.S. bond market. So with that being said, let's jump right in to what's going on inside of unemployment. Now, as you probably have realized, and I've discussed it here before, unemployment is at historic lows right now. I believe the current number is in the neighborhood of about 3.6%. And as I've probably told you before, many economists will refer to any unemployment rate below 4% as being fully employed. The point being that there's essentially 4% of the people you just can't get them to work. They don't want to work. They're not truly pursuing a job, even if the government stat says maybe they are. So we're at a very, very low rate of unemployment right now. Now, the Federal Reserve, although they have paused a little bit here, they are anticipating increasing the Federal Reserve rate again in the future, a couple more times, most likely yet this year. And they're going to continue to do so most likely until they see unemployment starting to go back up, because they want to use that indication as the cooling off of the economy, the cooling off of the market, the cooling off of inflation. Now, as we are seeing over here, this was quoted from Axios news source just in June, and they're saying that the Fed anticipates the unemployment rate will rise to 4.1% by the end of 2023. Now, from 3.6 to 4.1 doesn't sound like a lot, but it really kind of is. If you think about 4.1, so here's 4. So 4.1 is probably going to be somewhere right around in here is the last time we were at 4.1. And you're talking 2017, 2018 is probably when we were last at that high of an interest rate. This is a 25-year view of, I said interest rate, of unemployment, excuse me. This is a 25-year view of unemployment. As you can see, we are at that historic low level that we really have only seen, just prior to the pandemic, and now here. We were on a long decline here. Our spike up to 15% plus during the pandemic, but it has dropped dramatically. Back here, this was coming off of the financial crisis, 2008, 2009, and then the decline that we saw there, and obviously it shot up during the financial crisis. So getting back to 4.1% is going to likely require some more interest rate increases. But more than that, momentum is working against the Federal Reserve. I think it's going to be very difficult to get there. Let's take a look at this next shot. On this particular screen, this is an illustration, color-coded, which I'll explain here in a minute. And what they're saying is how many workers per state are available per 100 job openings. So if there's 100 job openings in a state, how many workers are there to fill that? So right here, just at the top of the country and right below the little graphic is the state of Michigan. Happens to be where I'm at right now. They're saying there are 85 workers for every 100 new job openings. So that's available workers. Look over here in North Dakota. There's only 35 in both the Dakotas for that matter, 35 workers per 100 jobs. There are only 5 states in the country that are over 100. So in other words, in California, for every 100 jobs, there's 110 job seekers. There's 110 workers. We go the other direction. We just talked about the Dakotas, but look at all the blue. Look at some of these numbers. These are all in the 40s, 50s. There's a 61 in Wyoming, 40s, 50s, 40s, 59, 58, 56. Look at all this blue all through here. Even up here in Maine and New Hampshire and Vermont, we're seeing a lot of blue. So the idea that we are this far below how many people are looking for a job versus 100 job openings, it's going to be hard to get the unemployment to go up much higher because there's just so many job openings out there right now. Now, you cross-reference that against the industries, and are they growing or are they contracting? So this is an interesting chart where they're breaking down the fastest growing, as you can see right here, where I'm turning it green now with my highlighter, the fastest growing and declining industries in the U.S. So right here, healthcare, everything's growing in healthcare. Down here, professional business services, everything is growing there. Leisure and hospitality, the blue, everything is growing. Services is split. So we've got across. Everything up here is growing, but this down here in the black, as you can see, is declining. So we've got private education, state and local government, passenger transit, film and video and audio, other personal services, and so on. Those are growing, but cable programming, satellite and telecommunications, rental services, newspaper and book publishing is declining. Down here, we also see a split in mining. We've got mining support activities up, but we've got coal mining down. Agricultural and and forestry support is up. We've got logging is down. And then manufacturing. All of the manufacturing is being predicted to be down. This is all numerics from 2021 predicted up through 2031. So a 10-year time frame. So as you can see, there is a shift. So even though there's a lot of job openings, some of the people who need to go to those jobs, if they're coming out of manufacturing and they're going into service or they're going into leisure and hospitality, that might be quite a change from their past. And so that also throws a wrench into some of these things in terms of how fast those jobs can get filled and how those job postings might linger out there because people have to convert their job skills and truly pursue some new careers in some instances in order to fill those jobs. So these things are all slowing down what the Federal Reserve is trying to do. But that being said, let's take a look at how this is all being impacted and digested by the market. Now, here we are looking at capitalization. And right here, this blue bar in the center, this is the overall stock market. And what we're seeing from an overall standpoint is down here, we have the trend. So we're still looking at green on trends all the way through all market capitalizations. And the trend is down here. And then we're looking at the swing. That's this red grouping here. And you can see everything in the short term is swinging red. So the swing is more of a short term. So here we are. We're looking at the overall stock market is showing an upward trend from early 23 through now. But we are seeing this short-term swing down here at the end. And that's this coming down right here. That we're seeing as well. Now, if we look as to, well, what's really pushing that? Well, although we've got all green on the trend, we've got all red on the swing, which again is tilting bullish versus tilting bearish. We are seeing large caps are continuing to win the day up here. The S&P 500, the NASDAQ 100, which is the QQQ, and the S&P 100, all large cap components are up here at the top of the heap, and then down at the bottom of the heap are the mid caps and the small caps. The mid cap 400 variations and the small cap 600 variations. So that continues to kind of hold true, if you will, as of our last few discussions. When we look at sector, and we assume all the sectors being equal weighted here in the middle with our blue bar, we are still seeing a long trend pattern here. So we're seeing that long trend pattern going from late 2022 to early 2023, trending its way up. But we are seeing right here, we're seeing this swing that's starting to take place in the short term. Again, we see mostly the green, mostly the red, which we'd expect because we're still looking at the same market. Now we're just looking at it from a sector basis. So what's really leading the charge is energy and telecom up here at the top. And what's putting a drag on things would be real estate and utilities. In fact, utilities are the only sector that are coming in as bearish on both trend and swing. So that's a bit notable compared to the rest of the group here. Now we are seeing ever so slightly, both of them are coming in green at healthcare, but as you can see, the numbers are very small. And then we're seeing both green up here on energy, which makes sense at the top of the list. Now, if we look at international and we take the total international stock market, we're still seeing a lot of green. We're seeing all this green on the trend, the longer term trends, and you can see from an overall market standpoint, going back to December of 2022 and coming forward, and here we've got this trend. It's not as strong as we're seeing in the US, but we are seeing it. We are seeing the swing coming down. And again, that's this swing down right here as well. So the international kind of falling in suit with what's going on here in the US, but not as strong as the US has been at least over this last year, which is the view we're looking at right here. And then finally, in the bond area, we're still seeing all kinds of red in the bonds. The overall bond market is seeing this downward push. Here's points of resistance. And here's points of support. As you can see, there's a definite decline taking place there. You can see that things are declining on the trend as of June-ish. And then we are also seeing a decline right in here taking place on the swing as well, which has turned red as well during this part. So we are seeing a little bit of a slowdown in some of these areas because, again, if we come back up here into the sectors, we're starting to see reds in the swing. We come back up here to capitalization, we're seeing red all over here. So in that instance, it's one of the reasons I think the Fed is seeing some cool down, but that's not being supported by the unemployment factor, which they have continued to hang their hat on, and I'm sure they will continue to discuss that moving forward. I hope you found this helpful. Thank you so much for tuning in. And as always, thanks for trusting us to help you with your investments.
Thanks again for listening to this episode of The Trending Report, powered by USA Financial. We invite you to visit usafinancial.com to find out more about our work with independent advisors and their clients all around the country. Any projections, targets, or estimates in this report are forward-looking statements and are based on the firm's research, analysis, and assumptions. Due to the rapidly changing market conditions and the complexity of investment decisions, supplemental information and other sources may be required to make informed investment decisions. All expressions of opinions are subject to change without notice. Clients should seek financial advice regarding the appropriateness of investing in any security or investment strategy discussed.